in this recording, we're going to look at problem 3 and look at particular types of items on the income statement and statement of retained earnings. So here's problem 3. Before we actually talk about each of these 6 items, I want to go back and review a couple of pages out of your textbook. First off is on page 169 of your book, looking at the particular items on the income statement, which we've discussed before, regular gains and losses, discontinued operations, and the particulars of those. And I really just wanted to bring this to your attention. This is a really great illustration here, illustration 415. And the other page is here on 172, and sorry about all the scribbling. Didn't think about wanting to use this until I'd already marked up my book already. But this really gets into summary of accounting changes and errors. So as I alluded to a little bit in the lecture with problem 1, we can have a change in accounting principle. So if we change from FIFO to a weighted average inventory, depreciation methods would be another issue. And so in order to be consistent on the income statement year after year, we have to go back to the prior years. If we go from FIFO to an average cost, then we've got to change what had been FIFO on prior years to average cost. So we have to go back and change the numbers on prior years' income statements. Of course, that's going to impact retained earnings as well. So we're going to have an adjustment, a debit or credit adjustment to our beginning retained earnings. Okay, let's look at corrections of errors. Corrections of errors also impact prior year's financial statements. So we have to go back and change the income statements from prior years so that we have a consistent reporting year after year. And again, that's just changing the income statement. We also have to change the accounting records. So all of those differences in the prior years in the correction has an impact on retained earnings. So we have to make a debit or credit adjustment to our beginning retained earnings. A change in estimate is really if we just change our mind about, how long we anticipate using an asset. So those I'll show how we address those as well. But we're not really going to have any sort of journal entry for those particular items. Okay, so in this particular item, we're really not preparing the whole income statement. We really start with income from continuing operations, which is quite a ways down on the income statement. So we're really just problem solving quite a bit in this particular problem. So we're actually going to start with the $790,000 and then make adjustments for it. So in the first one, we have a loss due to a flood. So we know, that actually goes above income from continuing operations. That would actually go, in regular gains and losses. So number 1, for the loss due to flood, we need to change our income from continuing operations for that $90,000. And that $90,000 should have been subtracted before we arrived at income from operations. Number 2, we have the beginning of 2015, the company purchased a machine for $50,000, salvage of $9,000, useful life of 6 years. The bookkeeper used straight line depreciation for the 2015, 16, and 17, but failed to deduct the salvage value in computing the depreciation base. So this is an error, right? This is an error. So we have a depreciation error because they have miscalculated this. And let's kind of go down and see what happened. What the bookkeeper did was just took the $54,000 cost and divided by 6 years. And got, an annual depreciation expense of $9,000. So that's what he or she had done. What they should have done was take the $54,000 and subtract the $9,000 salvage, right? Whoop. me see if I can clean that up a little. Let's subtract that $9,000 salvage and then divide that by 6 years. And if you do that, you're going to get $7,500 as our annual depreciation expense. So there's a difference of $1,500. And so in 2017, $9,000 expense got recorded. It should have been only $7,500. So we need to reduce depreciation expense by $1,500. So there needs to be an adjustment of $1,500 here. Now, do I add it or subtract it from this income from continuing operations? Well, if I reduce an expense, I am increasing my profits. So to shrink an expense increases profits. Number 3, sale of securities. So here we have number 1, number 2, number 3. Loss on sale of securities. That's just an ordinary loss. So loss on sale of securities, $57,000. Number 4, the president died. That's not good, is it? But anyhow, the president died. They got insurance back of $150,000. They had paid $46,000 for that. What is that? $104,000 gain then. So number 4, gain on life insurance. And so that's a common it's common practice to insure top executives. We'll make a note here though. I think it's going to tell us it's a non-taxable. So why don't we make a note for ourselves as well? The company does not have to pay tax on that gain. So when we calculate income tax expense, that's going to make a difference. Okay, number 5, the company has discontinued operations. That's not going to affect continuing operations. And number 6, so here we have discontinued operations. And here we have a change in the way they account for inventory. So here we have a change in accounting principle. That goes on the retained earnings statement. So number 5 and 6 will not play into income from continuing operations. So our corrected income from continuing operations, if I net 790 minus and plus all this stuff, I'll get $748,500. So first off, when you're working this in Wally Plus, you've got to figure all of this out before you can go put your solution in there. So let's go ahead now. We have figured some things out. And we know income from continuing operations now, before income tax, is $748,500. So we'll go ahead and put that in there. Okay, and the narrative tells us the income tax rate is 30%, but I do want to remind us the company does not have to pay tax on this life insurance, the gain on the life insurance. So we'll take that $748,500 So we'll take that $748,500, subtract the $104,000 of the gain. That net amount times 30% is $193,350. So income from continuing operations is $555,150. Okay, then we have the discontinued operations, which is what we saw in number 5. And so we have a loss of $115,000. And then we want to net out the tax benefits. So keep in mind, again, a 30% tax rate on $115,000 is $34,500. $34,500. So I'm going to have $80,500. Looks like I'm getting a little crooked here. So I have income from continuing operations, subtract, find out loss from discontinued operations, and I'll have net income, $474,650 for my final net income. The interesting thing in this problem is that they just have the loss on the disposal. Theoretically, then, that tells me this sale perhaps took place in January, or they didn't operate this recreational division during 2017 because there's no gain or, operating profit or operating loss is there. Usually we have the two items reported and we only have the one, so that was rather unusual. Okay, so that's solving for the income statement. Because this problem actually had a prior period adjustment and a change in accounting principle, I'm going to use it to lecture over those topics. So you will have other homework with this, but I'm going to use it, since we're already involved in the numbers, I'm going to use it. Okay, for the prior period adjustment had to do with depreciation. And sorry, I was not able to get these years changed from my notes. So 2015, 2016, and 2017. If you would make those changes, that would be good. Okay, so let's go back to number 2. Remember, we had the error in how they recorded calculated depreciation expense. The annual amount should have been $9,000. They were recording $7,500. So that was a difference of $1,500 each year. And that started way back in 2015. So we have corrected 2017, right? The income statement for 2017, we corrected that. We changed it from 9 down to 7,500 by, adjusting income from continuing operations. But we have the prior 2 years, 2015 and 16, that are in this accumulated depreciation. So we actually would need to make a journal entry. Let's see, $1,500 a year times 2 years is going to be a cumulative adjustment of $3,000. So we actually need to reduce our accumulated depreciation $3,000. That has been in depreciation expense of $1,500 for 2 years, totaling $3,000. So that has impacted retained earnings, right? Recall, expenses get close to retained earnings. So I can't credit depreciation expense here because in 2015 and 2016, depreciation expense was close to retained earnings. So that $3,000 is in retained earnings. Okay, I'm going to post this to accumulated depreciation. And so we would have a $15,000 revised balance. So our beginning balance would be revised to $15,000. And think about it, that makes sense. It should be, right, $7,500 for 2 years is $15,000. So the beginning balance, we've now corrected that. Okay, so that's one thing. Now let's go put this on our statement of retained earnings. Now I just made up a number. Here's our retained earnings statement. Let's just say it's $5 million. Now there would have been a depreciation error for 2 years for $3,000. Again, that's not 2015 and 16. We corrected it on the income statement for 2017. So only 2015 and 16 are in this beginning number. Now, we also would need to report the income tax expense effect. And I'm going to come back. When I finish this up, we'll talk about the tax impact as well. Let's go on to the change in accounting principle. So the change in accounting principle, that actually was not over here in number 6. So in number 6, the changing from average cost of FIFO, it increases 2015 by 60 and 2015 by 60 and decreases 2016 by 20. So the overall net increase in profit would be $40,000. So if I net the impact on income for 15 and 2016, it's an increase in the profit of $40,000 for those 2 years. So we would have had net income cumulative over those 2 years would go up $40,000. So retained earnings, again, profits, revenues and expenses are close to retained earnings. So I need to adjust the profits that got put into retained earnings by 40. Also, the cost of inventory, we're changing from FIFO to an average cost. We're going to increase our recorded cost by 40,000 just because of the difference in the cost flow method. Okay, so let's report this here as well. So we have a $3,000 prior period adjustment and a $40,000 change in accounting principal. And both of those have impacted 2015 and 16. Now we also have to net those with taxes at 30%, so $900 and $12,000. So if I net those, I'll get $2,100 and $28,000. And then all I do is I restate my beginning retained earnings. So what I started with, I add those in. So $5,030,100. That's right. So $5,030,100. We're going to go back. Net income. Put that in there. $474,650. There were no dividends. And so ending retained earnings, $4,555,450. Okay, so that gets at 2 of those changes, errors and change in principal. Okay, and the last one I want to talk about was the change in estimate. And this, I'm just making this up myself. So again, I need to change this to 2015, 2016, 2017, if you will. So I'm just going to redo, let's say that depreciation expense had of $7,500 was correctly recorded. And if it had been at the beginning of 2017, then it should be, right, this $15,000. So there would have been $7,500 expense recorded into accumulated each year, and that would total $15,000. So at the beginning of 2017, we would have that. Now, let's go back and look at, well, what if we changed our mind about the estimate? So instead of 6 years, what do we think? What if we think it's 9? So how do I go about and change depreciation expense? So I do the same thing, as I normally do to calculate depreciation. I take costs, subtract our accumulated, the amount that we've depreciated so far. And so I'm going to start with the book value. So our book value of this machine, right, the counting book value, cost less accumulated depreciation, is $39,000. Salvage, our estimated salvage value has not changed, so we still expect to sell it for $9,000 when we're finished with it. And so here's our remaining cost that we haven't, depreciated. So our remaining cost to be depreciated. Just depreciated. So we still have remaining cost to be depreciated of $30,000. We've only depreciated 2 years. We estimate a total of 9 years. So there are 7 years left. So our annual depreciation expense is going to be now $4,286. So instead of $7,500 in 2017, we're going to record depreciation expense of $4,286. So there's no actual adjusting entry, correcting entry for change in estimate. I do not go back and change prior years like we did with the change in principal and a prior period adjustment. I don't go back and try to correct prior year's financial statements. I just go forward with it. It's because Change in estimates are really common. It's normal to anticipate I would change my mind on an estimate. As time goes by, I have a better knowledge about how the value of the asset and how long we're going to use it.